So picture this, you're down at the pub and your mate Barry comes over. Barry tells you that you need to be investing in Facebook right now. It's growing rapidly, don't invest, you're an idiot, you're going to be missing out. Now, you don't really know Barry, he's a bit of a wheeler dealer, a bit of a geezer, you don't really trust him. You go home that night and you kind of do your own online research. Now, lucky for you, most large public companies like Facebook have earnings presentations, quarterly reports, and more importantly, the annual report. The annual report basically summarizes the financial performance of a company over the past financial year. So this will include the profit and loss statement, which looks at the income and expenses over the past year, and also the financial statement position, which looks at the assets and liabilities of the company as at a particular date. And this is used by various investors and various stakeholders to make decisions about the company. So you review reports and actually you end up agreeing with Barry. He's right, Facebook has good potential. So you want to invest and you call up your broker, you get them on the line, well actually scrap that, load up your iPhone, you load up free trade and you go to invest £2,000 in Facebook. I've only got 26p here, but go with it. Now the problem is, just before you press that buy button, you have a thought. We didn't trust Barry at the pub, so how do you know you can actually trust Mark Zuckerberg not to be lying about any of these numbers? I mean, Mark wouldn't lie to you, would he? Now, unfortunately, for various reasons, there's a number of incentives, opportunities, and pressures for management to manipulate those annual reports. Maybe management's bonus is based on meeting certain financial targets, and therefore by increasing the financial performance, say by reducing expenses and increasing your revenue, they'd actually hit those target metrics and be rewarded with a fairly decent bonus. And that scenario, I imagine, looks something like this. Management might be under huge investor pressure to make the numbers look better. Investors may be expecting a certain percentage of earnings growth each year, which management haven't achieved. The company may also be in debt or have loans with various banks. Those banks may enforce financial covenants that the company needs to meet, and so they may also try to manipulate the financial performance to meet those. Now, while this obviously clearly benefits management in the short term, for investors like myself, other institutional investors like pension funds, customers, suppliers, and even employees, this fraudulent practice is obviously damaging and can lead to, well, essentially total collapse of the company. Fortunately, we have auditors. The role of an auditor is essentially to check that the financial information a company puts out to the market is true and fair and accurately represents the financial performance and position of the company. And for most FTSE 100 or S&P 500 companies, the audit will be performed by one of the big four, being PwC, KPMG, Deloitte, and EY. The auditors will go through the annual accounts and make sure it's all true, fair, and accurate. There's a couple of key principles here. Firstly is the role of accounting and auditing standards. To ensure all the companies treat various accounting concepts and income and expenses and various other pieces in the same way, there are various accounting standards. One of the roles of the auditor is to make sure the company has applied those accounting standards in an acceptable manner. Secondly, based on current technology, it'd be absolutely impossible to test every single transaction throughout the year. Think for example of Apple. Now on average, Apple sells around 60 million AirPods each year, just over 2 billion iPhones, which I still can't believe that statistic, but apparently it's true. And 45 million iPads. You couldn't count every single one of those transactions. So what auditors do is they take a statistical sample of that population. They may only test around 100 transactions. And if they find any errors in those transactions, they'll be extrapolated to the rest of the population. Not every single balance is tested or reviewed. Only material balances are reviewed. So what do we mean by material? A matter is considered material if its omission or misstatement, and when we say misstatement, we mean kind of error, would actually influence the economic decision of a user. Now, it might sound a bit weird, but here's a very good scenario. Say, for example, you wanted to go to the beach and you looked at the weather on your phone ahead of going to the beach and it said it's going to be 30 degrees. When you got to the beach, it was actually only 28 degrees, but you know, it's still nice and warm, so you're not really too bothered. However, if the app said it was 30 degrees and you got to the beach, it was actually, say, 20 degrees or so, you'd be a bit annoyed. Because if you'd known it was going to be 20 degrees, you've never gone to the beach in the first place. So you could say in this scenario that 10 degrees difference is your materiality. That 10 degrees influence your decision. So if we apply this to financial statements, if a company had £1 billion worth of revenue, you probably wouldn't care if their income or expenses were wrong by 500k. You probably wouldn't even care if they're wrong by $1 million, but you would care if they're wrong by 10 million. So auditors use this concept of materiality to guide their testing. There are 3 key stages of the audit. The first is the planning. And planning is all about essentially risk assessment. You're trying to understand the business as much as possible. So you speak to the finance team to understand the transactions throughout the year, sales team, HR, the legal team, just to get a really comprehensive understanding of the transactions or events that the business has been through during the year. So you'll also do analytics on the company. Does the trends of revenue and expenses align to what you'd expect? Based on this comprehensive risk assessment exercise, you determine the key risks in the audit. You then go into the execute phase. Now, in the execute phase is where you actually gather the evidence. So for example, when we say gathering evidence, it will really depend on the area you're testing. So for example, if you're testing cash, which would be a balance shown in the statement of financial position, or you simply phone up the bank and ask for confirmation of that cash balance. If you're testing revenue, you may obtain contracts, invoices, and check that that money's been received. Now, these are very much transactional areas. And as you go up the ranks in audit, you'll be looking at more judgmental areas, such as provisions and legal cases. Take, for example, the recent recall of Peloton's treads. So 125 million treads, or basically treadmills, are to be recalled, which they've estimated will cost the company £165 million. This is a very judgmental area because no one really knows the exact cost of what this recall would be. And it's the role of the auditors to gather as much information from speaking to customers, the legal team, the finance team, to determine if that figure seems reasonable, and if it is reasonable, include it in the accounts. Now, once the various testings has been concluded, we move on to the third and final stage, which is your completion stage. Now, in this stage, you look through the financial statements, make sure all those numbers that you previously tested are accurately represented and appropriately disclosed. And finally, once you're happy, the partner will give you a seal of approval and sign the audit opinion. And this audit opinion provides reasonable assurance to investors, like for example me and Barry in Facebook, that the accounts are free from material misstatement and give a true and fair reflection of the company's financial performance and position. In the UK, the audit profession has been under immense scrutiny over the past couple of years due to a number of high-profile corporate scandals. This has led to ongoing debates by MPs and various other stakeholders about the future of audit, particularly around improving quality. As technology advances, the audit industry is looking to incorporate more technology into what it does. For example, the use of artificial intelligence, or AI, to actually perform risk assessment procedures and within minutes identify the key areas that need to be looked into further. This will also potentially allow the concept of real-time auditing. So for example, instead of waiting for the year to end and then performing your audit procedures, you could, through the use of artificial intelligence and other technologies, actually perform real-time auditing throughout the year. So for example, you can get, as soon as a transaction is posted or entered into the accounts, you can gain assurance that it's an accurate, complete and not fraudulent. Secondly, the use of drones to assess the physical condition of stuff like, for example, inventory or fixed assets. So instead of having to trawl around the country identifying these pieces, you can actually just send drones. So it looks like there'll be increasing regulation over the years and potentially even adopting an American style system. Now in America, they not only look at the financial statements, they also look a step behind that in terms of the financial controls that transactions go through to produce those financial statements. So, hopefully that gives you a nice high-level overview of what the audit profession is about. Like I said, it was a more theoretical basis, and in my next video we'll be looking at the day-to-day experience of a Big Four senior associate like myself. But until then, comment, like, subscribe, and leave any comments or questions down below, and I'll respond to every single one. So anyway guys, thanks so much for watching, until next time.